This analysis lays out a really strong consensus, strong buy case for RDDT. It's all driven by gap profitability, that critical AI data value, and accelerating ad growth, all pointing toward an aggressive 300 plus price target in 2026.
Right.
So let's talk about how to make this high conviction thesis completely undeniable.
Excellent. I think this piece does a great job articulating why analysts are, screaming strong buy. But for any analysis that's focused on such an aggressive upside, I mean, we're looking at a huge potential appreciation here. It has to establish credibility.
And that doesn't come from ignoring the risks.
Exactly. It comes from showing you've mastered the counterarguments. Okay, so the first major opportunity here is enhancing the completeness by really addressing the bear case and risk mitigation.
That makes sense. I mean, a key theme in the material is this rapid shift in what analysts are thinking. You see targets just vaulting from the 200s up to 270, even $300.
And the material makes a good case for that momentum, highlighting those three pillars: the profitability, the AI scarcity, the ad velocity.
Yeah, but the analysis right now, it focuses entirely on the strong buy side, the bullish target. It's missing a dedicated discussion of, the counter arguments, the things that could actually stop it from getting there.
And for sophisticated investment material, that's a problem. The absence of a real bear case section just reduces the perceived objectivity. Right now, the bull case is kind of sitting on a pedestal.
And you haven't given the listener the tools to really push on it.
You haven't shown them you didn't just cherry-pick the good news. So the suggestion here isn't to walk back the bullish stance at all. It's to integrate a clear section on risk mitigation that directly tests the durability of those three pillars.
Proving that you've actually vetted the potential headwinds.
Exactly. Let's attack your strongest points. Take margin durability. The report highlights these exploding margins hitting 91%, which is incredible. It gives Reddit those, software-like economics.
So how do we challenge 91% margins? I mean, that's a huge number.
You challenge it with the company's own growth strategy, international monetization. The material notes international is what, only about 18% of total revenue right now?
Right.
So what are the specific risks to sustaining those 91% margins as that international share scales? I mean, scaling in markets like Germany or Japan, that requires huge upfront investment.
Localization, new compliance, moderators who are fluent in those languages.
All of that. Those are overhead costs that directly pressure that high-margin compounder status. Even if the revenue follows later, you need to actually quantify that trade-off.
So it's not just flipping a switch, it's a major operational cost that actually threatens the 91% figure in the short term. And that detail shows the listener you get the operational risk.
Precisely. Next, challenge the AI reliance. The valuation premium is banking on Reddit being irreplaceable. But what are the counterarguments? What if, say, a new technology emerges? Maybe a synthetic data revolution that reduces the need for fresher, human-generated conversational data.
Or what if the pricing tower just erodes?
A much more immediate risk, right? What if the pricing power on those big licensing deals with Google or OpenAI just erodes when the contracts are up for renewal in a couple of years? If that revenue floor suddenly becomes negotiable, the whole scarcity premium is at risk.
And finally, that stock dip. The drop to around $207 is just called a dislocation.
Which isn't enough. Instead of just saying it's a temporary dislocation, you need to provide specific, structural downside scenarios that could turn that drop into a broken trend.
For example?
What if there are major regulatory hurdles around content moderation that could erode advertiser brand safety, cause ad yield to drop? Or, maybe the machine translation just fails to boost international revenue much beyond that current 18%.
Giving 3 specific structural risks like that actually makes the bull case feel more resilient.
Because you've already inoculated the reader against the common fears.
Okay, that comprehensive approach to risk will definitely sharpen the completeness. But let's move on to the centerpiece of the thesis, the AI data goldmine. The entire valuation premium seems to hinge on this idea of scarcity.
And that's your second big opportunity, sharpening the narrative on AI scarcity value and its irreplaceability.
The material makes a really compelling claim here. It calls Reddit a primary data source for the AI revolution, and it provides a revenue floor because AI models need this kind of human data to avoid model collapse.
All clearly laid out.
I wonder, though, if we've really defined why that data commands such a premium, and more importantly, why it justifies its $300 valuation.
You're saying the weakness is that it treats the licensing deals as a strength without digging into why Reddit's data is truly irreplaceable compared to other datasets. We need to define the moat.
We absolutely need to define the moat. The assertion that the data is scarce and valuable. It needs a much more qualitative and quantitative definition to justify that aggressive valuation.
So the suggestion is to dedicate a whole section to detailing the structural uniqueness, quantifying that competitive moat.
Yes, we need to shift the focus from it's a high-margin stream to it's a non-replicable asset, something competitors simply can't build.
Okay, building on that, what specifics should we detail? We need some clear examples of this uniqueness.
Let's start with the qualitative moat. Explain how the conversation on Reddit is structurally different. It's not like the general, ephemeral feeds on other platforms.
It's threaded discussions in these super specific niche sub-communities.
Exactly. And that offers a fundamentally different and superior training input. You should explain how that allows for fine-tuning specialized LLMs with a depth of context that, surface-level social media data just can't provide.
So using the term human-generated conversational data really highlights that unique structure.
It frames it perfectly. But let's challenge the quantitative side. If analysts see this licensing revenue as a floor for the whole company, how do we turn that stability into a growth driver that justifies the premium?
That's a great challenge. We need a quantitative tie-in that transforms that floor into velocity. The material should try to project the potential revenue velocity or future renewal strength based on the ongoing need for AI model refreshment cycles.
That sounds like a tough forecast. Are we asking the listener to forecast something that even the big sell-side analysts haven't really nailed down yet? Like the degradation rate of large language models?
We are. But this shows sophistication. You don't need a perfect number. You need a thesis. You can project a long-term growth rate for that AI revenue stream based on the assumption that AI models do degrade.
Meaning they constantly need retraining on fresh, niche human discourse to stay relevant.
By modeling that recurring high-growth engine, you explicitly justify the premium analysts are assigning based on true AI scarcity value. It's not just a one-time licensing fee.
And that makes the $300 target start to look achievable.
That level of detail on the data moat moves the thesis from compelling to proprietary. Now let's talk about tying all the components together. Our final critique is about the structure and the logical flow of the entire argument.
Right. Your third opportunity is explicitly linking the catalysts to the valuation premium.
I can see what you're getting at here. The material is strong on identifying the 2026 catalysts. You have the scaling of international monetization, reducing user acquisition costs through search dominance, and the momentum from that strong Q4 2025 guidance.
But the weakness is structural. The catalysts are just listed separately from the three core bullish pillars: the profitability pivot, the AI goldmine, and advertising velocity. You're forcing the reader to do the work.
To connect the plumbing themselves.
Yes, to calculate how scaling machine translation or cutting acquisition costs directly impacts the margin explosion or the ad revenue growth. You're forcing them to do the math that justifies that huge jump in valuation.
So the argument is sound, but the structure is making the reader connect the dots. The material has to show, not just tell, how these micro actions lead to the macro valuation.
Precisely. The suggestion is to integrate those specific 2026 catalysts as measurable accelerators under the relevant primary pillars. This gives clear, quantitative guidance on how the momentum justifies the targets from firms like Morgan Stanley, who talk about durable growth.
Okay, let's start with linking search dominance. The report says this catalyst reduces user acquisition costs. How should the listener explicitly connect that to the profitability pillar?
You have to state it clearly. Reducing customer acquisition costs contributes directly and sustainably to the longevity of those 91% margins. That's key.
Because the acquisition costs are usually the first thing to inflate when growth slows.
Of course. So if organic, high-intent traffic from Google Search, which is what search dominance means, becomes the primary user funnel, it insulates the margin profile. By stating this transforms the stock into a high-margin compounder, you solidify the entire profitability case.
That makes the profitability argument durable, not just a flash-in-the-pan number. Okay, now, international monetization. We noted it's only about 18% of revenue, but it's called a massive growth engine.
The advertising velocity pillar. If it's such a massive growth engine, show precisely how doubling or tripling the international revenue share from that 18% affects the overall 74% year-over-year ad revenue growth figure.
So we quantify it? If the international share moves from 18% to, say, 30% by the end of 2026, and that revenue has a different growth trajectory than the US market, how does that composite blend push the total ad velocity figure up or down?
Exactly. Quantifying that projection confirms the momentum that Truist Securities cited for raising its target to $270. Without that explicit link, international monetization is just an interesting possibility. With it, it becomes a hard valuation driver that supports the $300 target, piece by piece.
That integration really ensures the structural flow directly supports the price target. It transforms the material from just a collection of impressive facts into a cohesive, analytically robust investment document.
Right.
This has been a fascinating look into a highly aggressive investment thesis, RDD Price Prediction 2026, why analysts are screaming strong buy. So to wrap up, the primary actionable takeaways for the listener are threefold.
First, focus on strengthening the completeness of the thesis by integrating robust risk mitigation. That means dedicated bear case testing that directly challenges the durability of those bullish pillars, especially that 91% margin profile against international expansion costs.
Second, you need to sharpen the quantification of the AI data scarcity moat. Shift the narrative from its high margin revenue to it's a non-replicable asset. Detail the structural uniqueness of the data and project the velocity of its future renewal strength.
And finally, structurally, you have to ensure the 2026 catalysts are explicitly linked to the specific valuation premium. Don't just list search dominance and international monetization. Show exactly how they underpin the 91% margins and the ad velocity that mathematically justifies that $300 target.
You have a fantastic foundation here, built on strong evidence and high-level analyst consensus. Applying this feedback will move your material from a highly compelling argument to an analytically resilient and balanced investment thesis.